A lost decade is a term that means investors will see almost no return over a period of 10 years. There might be some volatility in the stock price, but at the end of the decade, investors are going to be pretty much in the same place they were 10 years earlier. This term comes from Japan when they suffered a lost decade in the 1990s. Japan had a booming economy, had loose monetary policy, and then a housing bubble that crashed. So their Nikkei index, the Japanese stock market, it hasn't reached new all-time highs since its old highs in 1989. The stock market has been on a real tear recently after the correction we had last year, and the S&P 500 is up 108% since its lows last March. Now, the S&P 500 is at all-time highs, people are getting nervous, and some really smart people are saying that this party is almost over and investors are going to have a really hard time over the next 10 years. Before I tell you who these really smart people are and how they think that we can protect ourselves, I'll ask you to hit the subscribe button, and if you don't want to hit the subscribe button, you can hit the thumbs up button too. That would be also very great. Okay, now, in September of 2020, Blackstone, the giant private equity firm, predicted a coming lost decade for U.S. investors. Blackstone's executive vice chairman gave an interview to CNBC. He believes that the near zero interest rates are the main reason for the rising stock market, and since bonds don't provide any return and there isn't anywhere else for investors to get a return on their money. He states that rates will either rise or at least they're not able to fall further, so borrowing costs for businesses are going to increase and squeeze profit margins. Earnings growth is going to face headwinds due to higher taxes, supply chain disruptions, de-globalization, and these are all going to cause operating costs to increase.
And so I think in the short term, you'll continue to have that momentum. Long term, though, I think the market will feel very full over a sort of 5 to 10 year horizon. I think this could be a lost decade in terms of equity appreciation, both because at some point we'll have interest rates normalizing somewhat, or at best stopping the further decline.
Ray Dalio, who founded Bridgewater Associates, the most successful hedge fund ever, he also fears that we could enter a lost decade, and he cited some of the same reasons as Blackstone. De-globalization, with companies like Intel and Taiwan Semiconductor moving their manufacturing to the United States. Even though it's more expensive, these companies are choosing reliability over cost optimization. And even Charlie Munger said something similar. He didn't say there would be a lost decade, but he did say that returns would be lower over the next decade than they were in the past. Bank of America has been the last to predict a lost decade, and their U.S. equity and quant strategist says that their valuation models predict flat stock market returns for the next 10 years. So investors could go the next decade making almost no money. No average 7% return in the S&P 500 like people count on. So how expensive is the S&P 500? The S&P 500 has a PE ratio of 28 right now, meaning that you're paying $28 for every dollar in earnings for the S&P 500. If you bought a lemonade stand and you got to keep all the money, it would take you 28 years to break even on that lemonade stand. Put this into perspective, the S&P 500 has only been this expensive during the dot-com bubble and the financial crisis in 2008. But it is coming down from a ratio of 37. Price to sales is the price we pay for revenue. This can be more accurate for growth companies or highly cyclical companies or companies that are not profitable yet. Price to sales has a ratio of 3.1, and this is much higher than any time over the past 20 years, where the average since 2001 is about 1.6. Another way we could value the S&P 500 is by yield. How much in dividends are we getting when we buy the S&P 500? The yield is 1.3%, and the only time we've had lower yield is during the dot-com bubble when we had a yield of 1.1%. So by these metrics, the S&P 500 does look expensive, and it is much better to buy things when they're cheap than when they're expensive. But just because they're expensive now, it doesn't mean that things can't get more expensive. Luckily for us, Bank of America gave us a ray of hope, a way for investors to protect ourselves over the next few years. And that ray of hope is dividends and reinvesting those dividends. Bank of America believes that reinvesting dividends could give us an equivalent return of the S&P 500 at 6,000. Right now, it's about 4,500, so that means a compound annual growth rate of 2.9%. And 2.9% isn't great, but it is better than nothing. She also lays out the 3 sectors that could benefit the most in the coming decade. The first sector to look at is energy. The energy sector is very closely linked to inflation. It's the first sector that will show signs, and some people can argue that inflation causes higher energy prices and vice versa, that the high energy prices cause inflation. That's how close these are related. Energy is required in all the aspects of the economy. You need energy to produce every product. Even software needs energy to run the servers and keep the internet on. You need energy to drive to work and just to keep the lights on so you can see. And inflation is picking up, and Jerome Powell has acknowledged this. The Fed is predicting an inflation rate of 4.2% by the end of the year, but they say that that's going to fall to 2.2% next year. And he believes that these increase in prices are from the same supply disruptions that Ray Dalio and Blackstone are talking about. The next sector that'll benefit is financials. Financials make money by borrowing and then lending out again and keeping the difference. If interest rates rise, this is going to lead to higher profit margins for financial companies. An example of this would be if a bank borrows $1,000 at 1% and then they lend it out again at 2%, they'd make that 1% difference, or $10. If interest rates rise to 1.5%, then they can lend it out again for 3%. That means they make $15 on the spread. Financials are the companies that pass the interest rates on to the rest of the economy through this borrowing and lending out again process, and lending to the consumers with loans and mortgages. Jerome Powell believes that now is not the time to raise interest rates, but others on the Fed board believe that increase could be appropriate in 2022. The third sector that could benefit during the next decade would be the materials sector. Companies that discover, develop, and process raw material. These are companies like the mining company Freeport-McMoRan or DuPont, which makes chemicals. These are basic materials, so they're used in producing new goods and services. Then these new goods and services will be passed on, and the cost of the inflation will be passed on to the end consumer. They should be able to protect their margins better since they're a bit further from that end consumer. These 3 sectors have the ability to profit from the increased cost of inflation and interest rates because they're a little further from that end consumer and should be able to pass those costs along. The stock market has a way of doing what's least expected by investors. During the financial crisis in 2008 and the last correction, the stock market crashed really quickly and recovered. Maybe the next time it could be a much slower grind that breaks the will of individual investors. How would it feel to see your stock prices just stagnate for years? Dividends could make a huge difference for investors, especially for those closer to retirement. I'd love to hear what you think the next 10 years are going to look like in the stock market. Go ahead, leave a comment down below. I personally don't know what will happen, but I think 10 years of no returns would be really hard for individual investors, especially the newcomers who just began with the rise of Robinhood. Please like this video if you learn anything. Subscribe to the channel if you haven't. I think that's all I got for this video. Hope you have a good day. Justin out.